Luxury watches are often seen as symbols of wealth and smart investments, but the truth is more complicated. According to recent analysis from Morgan Stanley and the Boston Consulting Group, outside of a handful of hype models, most new luxury watches lose between 20% and 40% of their value within just 3 years. This reality stands in stark contrast to the prevailing narrative of guaranteed appreciation. In this video, we're examining the hard data behind 5 sought-after models that the market shows will erode your capital. The numbers tell a story that many collectors overlook. Let's start by looking at a watch once celebrated for its technical innovation, but now facing a different reality.
The Rolex Milgauss stands out for its distinctive design and its once groundbreaking anti-magnetic technology. Originally engineered to resist magnetic fields up to 1,000 Gauss, the Milgauss appealed to scientists and engineers who needed reliable performance in specialized environments. However, the market for such a niche feature has always been limited, and the watch's technical advantage has since been eclipsed. Competing brands, most notably Omega with its master chronometer movements, now offer magnetic resistance of over 15,000 Gauss, rendering the Milgauss's original selling point far less compelling in today's landscape. The numbers reveal why the Milgauss struggles as an investment. A Milgauss reference 16400 GV, purchased new in 2018 for $8,200, now trades on the secondary market for around $8,500 to $9,500. At first glance, this appears stable, but after factoring in inflation, sales tax, and the opportunity cost of tying up capital, the real return is effectively negative. For perspective, a Submariner bought in the same year has appreciated by 50% or more, highlighting how the Milgauss has lagged far behind its peers. Production volume is another critical factor. Unlike Rolex icons such as the Daytona or GMT Master II, which maintain exclusivity through tightly controlled supply, the Milgauss has seen significantly higher production numbers. This abundance on the market dilutes any sense of scarcity, which in turn weakens demand and limits price appreciation. The Milgauss's quirky design and narrow purpose further restrict its audience. While diver and pilot watches benefit from broad, easily understood appeal, the Milgauss remains a specialized choice with limited crossover into mainstream collector circles. For investors seeking a better alternative at a similar price point, the Rolex Oyster Perpetual offers broader appeal and stronger liquidity. Its classic styling and versatility attract a wider pool of buyers, supporting more resilient resale values. This comparison underscores why the Milgauss, despite its unique history, remains a risky bet for those focused on returns. As we continue to examine popular models with disappointing financial outcomes, it's important to recognize that even watches marketed as symbols of sophistication can fall short. The next example highlights how the promise of prestige doesn't always translate into lasting value. Among luxury dive watches, the Omega Seamaster Diver 300M two-tone stands out for its blend of stainless steel and gold, a combination often assumed to guarantee lasting value. After all, gold typically signals exclusivity and higher status. But how much does this premium actually hold up on the secondary market? Before we reveal the numbers, consider this. What if the very feature that's supposed to set the two-tone Seamaster apart is the reason it struggles most? The Seamaster Diver 300M has a strong reputation for durability and a design rooted in Omega's maritime history. Yet the two-tone version tells a different story when it comes to investment performance. Market data shows that two-tone Seamaster models typically lose 30 to 45% of their MSRP within the first 3 years, compared to less than 15 to 20% for the all-steel versions. That's a significant gap, especially when you consider that the gold components often add a 40 to 50% premium to the retail price, a premium that is rarely reflected in resale values. The result is a steeper, faster depreciation curve for the two-tone models. Core dive watch buyers favor steel for durability, leaving two-tone demand weak. The majority of collectors and enthusiasts value the practical, understated look of steel, which aligns more closely with the tool watch ethos. The two-tone aesthetic appeals to a smaller, fashion-driven audience, and this limited pool of buyers translates to softer demand and lower liquidity on the secondary market. Omega's production strategy compounds the issue. The brand's high-volume output of mass-produced dive watches, with frequent updates and new variations every year, further dilutes the exclusivity of the Seamaster line. Two-tone models, in particular, struggle to stand out in this crowded landscape, making it even harder for owners to recover their initial investment. When you add in the unrecoverable gold premium, the financial case for the two-tone Seamaster becomes even weaker. Ultimately, while the two-tone Seamaster Diver 300M offers visual distinction, it rarely delivers on the promise of long-term value retention. For buyers focused on wealth preservation, it's a cautionary example of how added luxury features can sometimes undermine investment potential. This dynamic isn't unique to Omega. Other brands also face challenges when style and tradition outpace underlying demand. The IWC Portofino is positioned as the brand's answer to understated elegance, a clean, refined dress watch with broad appeal. While its minimalistic design and polished lines attract buyers seeking a classic look, the Portofino's long-term financial performance tells a different story. For those considering it as an investment, the numbers and underlying mechanics highlight persistent weaknesses. Within IWC's lineup, the Portofino faces an uphill battle for attention. It lacks the strong brand identity and horological cachet seen in the Pilots and Portuguesa models, both of which are more closely tied to IWC's history and technical achievements. Collectors often gravitate toward these lines for their in-house complications and iconic status, while the Portofino rarely commands the same level of enthusiasm. This absence of a compelling technical narrative limits its desirability in a market where heritage and innovation drive value retention. Movement choice further undermines the Portofino's appeal among knowledgeable buyers. Using the Valjoux 7750, a ubiquitous ébauche, dilutes exclusivity compared to in-house caliber's collector's prize. The Portofino chronograph, reference IW3910, exemplifies this approach, relying on a modified movement found in numerous models across the industry, including brands at lower price points. As a result, collectors see little incentive to pay a premium for a watch that lacks unique mechanical substance, especially when alternatives offer more technical distinction. Price dynamics also work against the Portofino. IWC dealerships frequently discount these models by up to 25% off retail, immediately lowering the future resale floor and signaling to buyers that secondary market values will be even softer. Secondary market values often sit at 40 to 50% below retail. Even a decade in, owners report steep declines. For the same price, Jaeger-LeCoultre or Zenith in-house movements hold value far more consistently, offering both horological significance and better protection against depreciation. IWC's strategy of broadening the Portofino's accessibility with mass-market releases has not translated into long-term value retention. Instead, the model's lack of technical exclusivity, frequent discounts, and weak brand association have combined to erode its standing as a viable investment. As we turn to another once-celebrated icon, the question becomes whether strong design alone can sustain value, especially when aggressive production and shifting brand strategies reshape collector sentiment. Panerai floods the market with upwards of 50,000 base Luminor watches annually, eroding scarcity and shifting the dynamics of what was once a celebrated icon. The Luminor's bold case and signature crown guard built a strong following in the 1990s, with enthusiasts drawn to its military heritage and functional design. Yet the strategy that initially set Panerai apart now works against it. Today, the brand's frequent special edition releases and high-volume production have saturated the market, making it difficult for any single model to stand out or retain value. Unlike brands that rotate core collections, Panerai reuses the same Luminor blueprint, offering little novelty to sustain demand. The result is a crowded landscape where even non-limited models compete with a steady stream of new, nearly identical releases. This repetition dilutes the appeal of the core collection, and the lack of scarcity makes it challenging for base models to command strong resale prices. Collectors and buyers are left questioning the value of paying full retail when a seemingly more exclusive version may be around the corner. The financial consequences are clear. A new 2025 Panerai Luminor Marina, priced at $8,800, can already be found on the secondary market for as low as $6,500. That's an instant 25 to 30% loss, often within months. What other benefits are you sacrificing for Panerai's iconic look? Depreciation rates for non-limited Luminor models typically fall between 25% and 40%. This consistent pattern signals a high-risk proposition for anyone focused on wealth preservation or long-term value. While some luxury watches experience moderate depreciation, the depth and speed of Panerai's decline stand out, especially for a brand positioned as a premium choice. Panerai's over-reliance on a single design language and its aggressive release schedule have contributed to a perception that prices are 30–40% too high for what the market will bear. The base Luminor, once an object of desire, is now seen more as a commodity than a collector's asset. This trend raises important questions about how brand strategy and market perception drive value. Not every polarizing design or bold marketing move guarantees lasting appeal or financial security. Some classic fusion models plunge 60% in under 12 months, setting a new standard for rapid luxury watch depreciation. Research shows a $10,000 classic fusion often resells for $4,000 to $5,000, a dramatic hit compared to Rolex's stability or even the more moderate declines seen in other brands. This steep drop isn't an outlier. It's a well-documented trend that shapes Hublot's reputation among both collectors and investors. With Solita movements found in sub-$2,000 watches, paying $10,000 for the classic fusion forces a steep premium on marketing rather than mechanics. For buyers who prioritize horological substance, the value proposition quickly unravels. The classic fusion's divisive design, while bold and distinct, does little to offset the absence of technical innovation or exclusivity. Collectors consistently note that Hublot's focus on image over movement quality leaves the watch struggling for respect within the enthusiast community. Hublot's market approach amplifies these challenges. The brand invests heavily in celebrity endorsements, sports sponsorships, and high-profile events, making its presence felt far beyond traditional watch circles. Does sponsoring sports teams translate to collector value? The resale data suggests otherwise. Instead, these marketing efforts inflate retail prices to cover massive promotional budgets, pushing the classic fusion's MSRP even further out of line with its underlying value. While limited editions occasionally perform better, the core classic fusion models remain particularly vulnerable to sharp, early depreciation. Compared to brands that emphasize scarcity, craftsmanship, or in-house innovation, Hublot's strategy leaves the classic fusion exposed. For most buyers, the watch is a fashion accessory, a statement piece rather than an investment-grade asset. Industry experts highlight that, outside of rare exceptions, Hublot watches are rarely purchased for their long-term financial prospects. The pattern is consistent: high initial outlay, limited collector interest, and rapid value erosion. When the numbers are this clear, relying on brand image or marketing alone is a risky proposition. The classic fusion's trajectory underscores the importance of looking beyond surface appeal and focusing on the fundamentals of value retention. This theme recurs throughout the luxury watch market, where data, not just recognition, sets the winners apart. In today's market, illusions of prestige can obscure the realities of value retention. Protecting your capital means focusing on scarcity data, real-world resale pricing, and proven depreciation curves, not just brand reputation or marketing stories. Many of the models discussed here demonstrate how overproduction and weak demand can quietly undermine even the most recognized names. If one of these watches surprised you, let us know in the comments below. Your experiences and questions help shape future analyses. Next time, we'll flip the script to uncover hidden gems that defy these trends. So hit subscribe and ring the bell for more exclusive insights into navigating the world of luxury watches with confidence.